Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today, I'm also joined with my good friend Phil Weiss. Hey, Phil.
Hey, Kirk. Thanks for having me here today.
Thanks for coming on. Well, Phil's one of our new panelists, and Doug is off on vacation, sunning himself in sunny Minnesota today. So we're we wish you all the best, Doug. But I think we're good. We're happy we're not living in Minnesota. Um, so Phil's joining me this week, and we're just gonna kind of dive right in. So Phil, what's going on in the world? What do you want to talk about? You're our new kind of guest host here. So where do you want to start the conversation?
Let's just start talking a little bit about what's going on in the market. I think that's a good place to start.
All right, let's do it. So the markets have been puzzling to most people. I know, Phil and I talked to a lot of institutional investors, a lot of, as we say in Boston, wicked smart people in the finance world. And, most of those people, especially the ones without that accent I just gave, are really timid about the market's direction. I wouldn't call them confused. I think everyone always has a really strong sense of where things are going. But as they say, I'm frequently wrong, but never in doubt. Right? That's
Yes.
the term you could describe these people with. But I think it raises some good questions that I want to get Phil's opinion on. Is that people have been talking about a recession for a long time, and we're not seeing it. I mean, you can start to kind of see it, but we're not seeing it. And the data alludes to we should have one anytime, but it's not showing up. So, Phil, what are you seeing? Like, what do you make of this topsy turvy, weird Alice in Wonderland market?
It is pretty crazy. And if I look at the market in general, yesterday we're 20% up from the October lows. So some people would say now we're into a bull market. It's no longer a bear. The economy is hard to figure out. We got inflation. Normally when we have inflation and we have an inverted yield curve, which means that if I look at interest rates, the long-term rates are less than the short-term rates. Those kind of things usually mean that a recession is on the way. But earnings for the first quarter were good. So we get a lot of conflicting signals. It's not simple. I mean, none of us can forecast. Like that's the thing, right? But I always take the overall view when I'm investing. I'm taking a view the market's going up long term, and I want to keep that long term outlook.
Yeah, so I want to come back to that, but I do want to point out a mindset thing. We like to talk about those in the show because we can give you all the data you want, but it's not going to help you. What's going to help you is how to think about the markets, as we talk about every week in the show. So I'm going to take something Phil said and I'm going to point it out because most of us, well, everybody hears this a lot, and most of us just don't think anything of it. So what Phil said is the markets are up 20% from the October lows. Now, what does that mean? Well, frankly, it doesn't really mean anything because it really what it comes down to is at what point in time are we talking about? Now, Phil picked out a point in time, and I'm not ripping on Phil because what he did is actually really important. But what a lot of people do, if you watch CNBC, and please don't watch CNBC, but if you happen to watch CNBC, you're going to hear a lot of this. Oh, it's up X from the low. Well, who cares what the low was, right? Did you buy it at the low? Did you sell it at the top? So the tops and bottoms are really irrelevant when it comes to things. But people like to point them out because it shows a big number. Now, if you actually looked at the S&P 500 for an example, and you looked at it from pretty much, you could look at it from the beginning of, not even the beginning of 2022. If you look at like mid 2022, I'm sorry, I'm looking at the wrong. My chart's a little off. So if you look at basically 2022 and 23, if you look at that time period, except for Q1 and 22, the markets have pretty much gone sideways. They've gone up and down a lot, but it's been within a range. And you could argue what that range is, whether it's valid. But what a lot of people do is they'll pick a point in time and say, "Oh, the market's down, 30% from the high." Well, that doesn't matter unless you bought it at the high, right? And the low doesn't matter unless you bought it at the low. And what typically happens is people do neither, right? And I want to point this out because I think it's a really important mental model to have when it comes to investing. And I hear this a lot. I get this question all the time of, I'm down X amount from the peak. Well, who cares what the peak was? The peak is an imaginary number. So imagine this, right? You say you have $100 and you go to the casino. You turn that $100 into $1,000. You're on a roll. You can't lose, right? You're making money. The pit boss is staring at you. He's saying, "Oh, is this guy cheating?" You're doing that well, okay? Um, and all of a sudden, your luck starts to turn. So you turn that $1,000 back into 500. Now, most people will say, "I just lost $500." Now, why would you say you lost $500? Because you looked at the thousand and said, "That's my money." But I lost $500 of my money because it was off the peak. Well, technically, it's not your money until you push away from the table and you take it home and you do whatever you want with it. Then it's your money. But what most people do is they say, "Well, I'm going to keep going. I'm going to let it ride. I'm going to keep going and keep making more money." Well, at some point, inevitably, your luck will turn and you'll lose money. Now, in this case, you lost $500. Or did you lose $500 or did you make $400? And this is what I want to point out. People look at the peak and they naturally assume, "I lost all that money." Well, you started with 100 and you turned it into 500. That's actually a pretty good gain. That's a really good gain. And anybody should be happy with that. But we don't think that way because our brains are wired to think about, like, what's the most recent thing? And they pick a point in time and they say, "Well, it's down this much from the peak." Well, it doesn't really matter. Because if you made a lot of money and it's down from the peak, you just made a lot of money still, even though you didn't make as much as it could at the peak. And, I hear this with crypto people a lot, like, "Oh, I should have sold the top." Really? I mean, would you have? Even if you knew the top, would you have sold it? Probably not, right? So I point these things out because the mental model is really important because it will cause you to lose money and it'll cause you to miss the bigger picture. So this year, the market is more or less sideways. It's up technically for this year, but if you pull back like a 12-month window, it's pretty much sideways. It's up a little bit. I think it's up maybe like the S&P is maybe up like 3% or something. But if you look at the scope, it's basically sideways. And you really have to look at a chart to see this. If you're just reading numbers or you're hearing people talk about it and you never look at a chart, you're probably going to miss the picture and what this looks like. Go to Yahoo, pull up a chart of the S&P 500 for last year, and you're going to see what happened. And you're going to notice something really important. It's done a lot, and it hasn't moved all that much, right? It's gone down a lot. It's gone up a lot. In last year in July, it was down. Then it went up a lot. And then it was down even lower in October. And then it went up and then down and up and down, just like the market does. But that's less important. What's important is taking the bigger picture and looking at it and saying, what is the trend? Is the trend up? Is it down? Or is it sideways? And if it's sideways, then you're really not losing track because it's just kind of bouncing back and forth. Now, if it's a trend like we had up until the end of 2021, we had a really bullish trend from 2009 to 2021, one of the longest bull markets ever. And people made a lot of money just by being bullish. But we're not in a bull market right now, unless you're using Phil's definition of a bull market, which you could have different arguments for. I'm not saying Phil's right or wrong. It's just, people come up with arguments around a bull market or bear market and whether we're in a session or not. So these terms, albeit are important to define, you could argue that people define them differently and such that it will actually cause people to be confused and maybe get the wrong information. So I think this mental model is really a good takeaway for this session. And I want everybody to just think about it because, people will pick points in time, and Wall Street's really good at this. Is what they'll do is they'll say, "Oh, if you did this thing with these metrics, you would have done X." Well, all they did is pick a point out of thin air that was most favorable to their thesis and said, "Wow, my thesis is correct." Well, what if you apply that thesis to 50 other scenarios? It probably wouldn't be correct. And here's a famous one. Where I learned this in the first month of working at Payne Weber, where they sent me this chart and it said, "You have to be in the market because if you miss the 10 best days in the market, instead of making 10% a year, you would have only made 2% a year." Well, wow, I better stay in the market. And everybody's seen this chart. I better be in the market because I'm going to miss out on 8% a year. Well, what they don't tell you is if you miss the 10 worst days in the market, you would have made double that. So instead of making 10% a year, you would have made 20% a year by missing the 10 worst days. So what they do is they selectively pick data to show a thesis to support something they want you to do. And so if you're listening to Wall Street, the big firms, they do this every single day. They pull out things to promote a thesis that they're trying to promote so that you follow them and you feel like these people are really smart. I'm sure they're smart people. I'm not taking anything away from them, but you should know what they're doing. They're playing with the data and they're manipulating your feelings. So just understand that. Phil, you've been around for a while. What do you think? I mean, you see this a lot?
Absolutely. And as you're talking, Kirk, I think of this story that you look at any stock, right? I'm not even talking about the market, but you look at a stock and look at its 52-week high and 52-week low. And somebody will say, oh, well, this stock was trading at $100 and now it's at 60. So it must be a buy because it used to be 100. Now it's only 60. But we don't know that it was ever really worth 100. That's just a reference point, kind of like what you're talking about. That doesn't mean that the stock was worth that. Doesn't mean it's ever going to get back to that. So many stocks hit a number. Like look at Cisco, right? That stock peaked in the bubble, the technology bubble in the early 2000s. It's never been back to where it was. So we can look at all those old values, but they don't mean anything. So it's all these things give us reference points. That's what they do. You know, I dare anybody to prove to me that the value of a company changes as much as the fluctuation between its 52-week high and 52-week low would imply. It doesn't. But the markets, we get excited, right? And things go up. We get scared and things go down. It's not about trying to, like, the media loves to also talk about, you got to beat the market. You got to beat the market, right? But nobody really can beat the market with any level of success. That's not what it's about. We're doing this so that we can live the lifestyle that we want and do the things that we want. Beating the market doesn't matter. If we can live our life the way that we want to, it doesn't matter if we beat the market or not. And trying to beat the market usually means we're trying to take on a lot of risk. And that jeopardizes our chances of success rather than helps it.
Yeah, that's a great point, Phil. I think that gets lost in a lot of people is what is the actual purpose? And everyone gets stuck on beating the market. This is something people talk about over and over and over again. They want to beat the market. And as you said, there are a few people who successfully beat it, like Warren Buffett, but that's over long periods of time. You know, there are some people, there's a handful that have done really well, but they're few and far between. And the reality is, even the people that are really good at beating the market, people tend not to stick around with them because if they're beating the market in the upside, they're also beating the market in the downside, assuming you're trying to lose money. So they tend to be more volatile or higher beta. And so, you know, if they're beating the market by 10% a year and the market's down, they're probably losing by 10% a year, just statistically. There'd be somewhere in that range. So what happens is the market goes down and people don't stick with them because their performance is poor. And what happens? The market goes up and then they outperform again because that's their style, right? And so I think what's challenging is not only that you know, people get caught up in this beating the market and this competitive edge, but many times they don't even have a goal with it. It's just growth for the sake of growth. And that can get you into trouble, right? Because we've had the last 30 years maybe where not even no 20, I think it was the late 90s. I think it was like around 2000 or so when the Fed started cutting rates, or they rose rates enough. I think it was like what 5-6% back then. So I think that was the last time we had reasonable rates where you could actually save money, you know, and get like 5-6% yield. And we've had 0% rates for so long that everyone's just gotten stuck in this equity at all costs. We just got to put all our money in and let's just grow it. But that's not history. Like history shows that there are times where that's not a good bet. I mean, you know, I'm not going to say the name of the stock, but there's a stock Nvidia that it, you know, has blown out all the numbers this year in their returns and has skewed a lot of the performance. And if you look at the PE, it's like 200. So what that means is it's going to take 200 years for the earnings to catch up to the price. That's like insane numbers. Now, I'm not saying it's not worth that. I mean, I don't know. I mean, who, you know, I mean, if who knows what's going to happen with that stock. But the point is that sometimes some stocks can get a little extended from a fundamental perspective, and they might be, as Phil said, Cisco's a great example. It's a great company, but it overshot in the 90s and it hasn't come back to the peak from before. So what does that mean, right? Um, oops, I didn't lose everybody. But and then and it hasn't come back. So there's always this question of, did I overpay? What's the trend? And just being in equity because you think it's going to go up over long term can be a challenge if we lose, like in the early 2000s, we lost 13 years of time. The indexes didn't go anywhere. They went sideways, a big range of sideways, like 50% range of sideways. But they didn't start making money from early. And I'm going to pick a point in time. Now I'm going to do this magic trick on you too. January of 2000, you pick that point in time, put money in. You didn't make money until July of 2013. So you lost 13 years of time. Point being is, you never know when that's going to happen, but you always have to be mindful of the fact that the markets don't always go up, and sometimes beating the market is just not losing money, right? So, what are your thoughts, Phil?
We're on the same page, Kirk. And the other thing that I thought of as you were talking about, look at mutual fund investors. You can have a mutual fund, ETF, whatever you want to call it, it's actively managed, and nobody knows about it until it starts to perform well. Then people see that it performs well and they dump their money in. And now it's bigger and managing it is different, and whatever they were doing might not work as well. So then it starts to go down, and then people get out. And then, like you said, then it starts to come back. And so you look at the performance of the fund versus the performance of people that held it. They don't even match. The fund outperforms the people that held it because we're chasing all the time. Either we're chasing on the upside and we're running away on the downside.
Yeah. Yeah, and so I think the challenge is we've all learned these mental models of what you should do as an investor, as they call best practices or rules of thumb, right? Buy and hold, buy the dip, don't get out if the stock market sells off, don't chase, don't try to beat the market, diversify, index, all these principles that people have espoused as being best practices. Now, of course, you can argue some of them, whether they're better or worse than other things. I mean, that's kind of irrelevant. But in large part, there are some best practices that I think a lot of people hold dear. Now, those best practices work well in certain types of markets. Those markets tend to be bull markets. The principles for bull markets tend to be more or less uniform. Buy and hold, buy good stocks, let them run, all that. Those are good tactics in bull markets. Bear markets are different, though. They have different principles. They act differently. I always think about it as markets are meant to cause the most amount of people to lose the most amount of money. Like if you think about it in those terms, basically do the opposite of what your natural instincts are telling you, you're probably going to have more success than most people. And I think that, if we're in a bear market, we have different rules, right? We're going to talk about some of the things that are going on now, but um, as Phil said, we could very well be in a new bull market. I don't buy that quite yet because I think there's a lot more there. But I think that the principle, if you use that principle, okay, then yeah, if you buy that. But I also think in bear markets, if you look back in history, the one thing they're really good at is confusing a ton of people. And there was a great book I read from the 70s, which was the one aspect that was uniform in the 70s was mass confusion about what was going on in the markets. And people thought, oh, this is true. And then it turned out to be different. And no one really had a good grasp on the stagflation that was going on, and they didn't really understand it. And, people always think they have all the answers, but there was a lot of confusion about it. And I think right now we're in a period which is very similar where people are confused, right? We're going to talk about this right now, which is, you got the housing market, you get the stock market, you get all these different markets, you got unemployment, you get inflation. And it's like, what is going on? Why are things not operating in the way that everybody expects?
Did you miss your opportunity to get PPP money during COVID? Are you waiting for our president to forgive your student loans? Are you excited about helicopter money? Me too. If you want free money, look no further. I'm giving away free money this week on our show. All I ask is 5 or 10 minutes of your time. I'm so excited to give you free money, I can hardly contain myself. Take advantage of me and my excitement to get your free money. Go to www.moneytreepodcast.com/free money. Follow the instructions today and get your free money.
So, Phil, maybe you can kind of talk a little bit about some of those things that you're seeing, and we can kind of dive in a little bit.
Sure. So let's start with the housing market. We have an environment where interest rates are up a lot from where they're lows. I mean, you have people that have mortgages that are in the sub 3% range if they timed it well and refinanced after COVID hit. Those people don't want to sell their house that easily, because if they sell, their mortgage rate's going to go, and buy a new house, if they can't pay cash, the mortgage rate's going to go up a lot. You still have people that want housing. So you would expect, though, in a rising rate environment, when the cost of owning that home because of higher mortgage costs goes up, that would have an effect on prices. But yet we haven't seen housing prices go down markedly. And if I talk to realtors, they'll tell me, well, here's the reason. There's no supply, because you got the people that have those low mortgages, they don't want to sell. You have the people that may have a reason to buy, but they can't find anything to buy. So then when they go buy, if they do find something, they pay more than you would think in this environment, because they need, for whatever reason, they want or they need that house, and they have to pay up for it. Like that, but that's a disconnect, right? You wouldn't think that you would have rising rates and housing prices not going down.
Yeah, I think we talk about housing a lot on this show and the implications, and like you were saying, I mean, I was just looking up what the average mortgage rate right now in the U.S. is, and it looks like it's down to 7%. I guess it always depends on your site. I think the site I had the other day that I pulled up for the show had the rates were a little bit higher, I think, than the average rate, but they were still, apparently, for someone, because this was, I mean, it was through Google they picked this up, and that site now says 7.5. If I'm looking at Bankrate, I think it's right around 7.08% is the average, the national average of the 30-year fixed. Well, either way, whatever it is, 7.5, that's really high. As Phil said, it was like 3%. I think it went down to 2.5 at the very low, was the lowest I saw, at least on websites, for a 30-year. So we're close to double the monthly payments, or a little bit less, but it's still really high, and real estate prices haven't dropped. So I mean, in your experience, I mean, Phil, you've been around for a while. So in your experience, like, I mean, you've got a lot of equity tied up in real estate. Like, what do you think is going to happen here with the housing market? I mean, it's a little bit weird.
It's very weird. I was talking to somebody today about this. They want to buy a house, but they're going to pay cash. I said, well, that actually gives them an advantage, right? Because they're selling and they're going to retire and they're going to move someplace else. And so they're going to take what they get for their current house, and they have enough cash to add to it to buy. I said, in this market, that gives them an advantage, because they don't have to worry about what the interest rates are. They're in a position where they can afford that. And that's actually, when people are selling, that's something that they look at, because they don't want to deal with, are you going to get approval? Can you pay for this or not? I do think that eventually we're going to get to a point, though, where we are going to see, I'm not saying it's got to be a 2008, 2009 event, though I don't know for sure either. I never profess that I can forecast accurately, because there's too many unknowns. But I do think that we're going to get some downward pressure on housing prices unless mortgage rates come down, because it's just, you said, what you're paying is double, roughly, what you were paying a few years ago. That has an impact. You can't buy as much house. Either you're going to have to buy a smaller house, or you're going to have to wait. So it's not easy to figure out what you're supposed to do, but I think that eventually we're going to have some pressure on housing prices, but we're just not there yet.
Yeah, I mean, what do you think is going to cause that? I mean, because we've been talking about this on the show for a while, and it's still not budging. Even last year, housing prices, the median home price went up 10%, if you can believe that, with all that happened last year.
I wish I had a crystal ball that told me when it went. I don't know. I just, logically, it makes sense to me that it'll happen. But, I used to be an oil analyst, and I used to say, if you go back to 08 and 09, and oil prices went over up to about $150 a barrel, and then they fell down to 30. And I know not one analyst that had to forecast oil prices that saw that happening. And when people used to call me and ask me, what do you think is going to happen to oil prices? I'd say, well, part of my job, I'm supposed to predict it. So I'm going to give you a number. And now that I've given you that number, I'll tell you one other thing. There's about one number I know what it's not going to be. And that's the number I just gave you. So, I mean, that's how
Wait,
it is.
you told somebody that, Phil? You let him behind the curtain? Come
I
on,
sure
man.
did.
Well, that's why we have you in the show, Phil. So maybe we can segue into oil. Where do you think that's going right now, Phil? Make sure I bet against that number.
Yes.
Go in the roulette wheel. Put every number but that one.
That's it.
All right.
Hey, I did get it right once. I did it for 28 quarters. I got it right once.
Nice. Well, I mean, I think it's a good segue because oil actually is another market that is a little bit nutty that we've been talking about. We've had a few people on the show recently learning about it. I'm not going to ask you the price, but I think it's what's been interesting is the Ukraine war and things have softened quite a bit. And if I look at the big macro trends in oil, natural gas, they lead me in one direction and the prices go in the other direction. So what's your take on the sector in general? Like, what do you think's happening there?
It's interesting to me because you have competing pressures, right? Supply is always an issue. And if I look like at the US and all the shale oil that we get, those have a different profile than the conventional wells that we had over the years. So they can't keep the production up as easily because the production falls off more. You have the environmental side, concerns about global warming. You have people that want to move away from oil to other fuels, but it's not going to happen that fast because it takes 15 years or so to turn over an auto fleet. So it's not like you can say, okay, we need to all be driving electric cars, and that's not going to happen that fast. And you still need to generate the power, even if it's running on a battery. Those batteries have to be recharged and the power comes from someplace. So the supply demand dynamics change, right? I don't have a good feel for it. It's not like I don't have the same feel for what's going on in oil as I did when that was kind of my work life. That's what I did every day.
Yeah.
But prices in this environment right now, I mean, they seem a little bit low because you mentioned the war, right? And you don't want to take production from Russia. So that impacts supply. The Saudis said, but they don't always follow through on these things, that they're going to produce less. You would think that prices would be higher than they are. I'm surprised that they're at the level that they're at. They went up at the beginning of the war. They've come back down. If we go into recession, like that's another thing, right? Normally we're in recession because oil has so much of an impact. It's involved in so many things in the economy that if we have recession, that's going to put some downward pressure on prices. It's hard to say for sure, but because there's a lot of competing factors.
Yeah, it's interesting. I mean, I've been curious about the price as well. We went from a negative $23 a barrel during COVID up to $130 a barrel last year, and I'm not sure how much has changed, but the just following some people that are more, I guess, active in the space. The challenges that I see, at least trend wise, is you're not reinvesting into new wells, right? And that might not affect people right away, but eventually it will. And I kind of see this as this kind of funny political game. Funny, like, not that funny, but funny in the sense that, like, if you know what's going on, it makes you laugh and cry at the same time. Which is, oil companies have been not altogether all that profitable, in the last few years, and then pretty much the administration came out and said, yeah, we're kind of against this. And so the oil industry is like, well, we're not going to reinvest into new projects because we don't know where the political winds are going, right? We're not going to invest in a project and you to tell us that we're going to lose money on it. So we just won't do anything. And it takes years to develop these projects and to bring them to till they're active. And then, so in the short term, they're not reinvesting in CapEx, which are these new wells. So they got all this extra profit. And then the administration comes after them and says, hey, you got excessive profit tax on you. It's like, no, like, we're not making more money. We're just not spending on projects because you're telling us not to. I mean, it's kind of like if I was a politician, I really wanted to get rid of this. Like, I I would have set this up for this. I mean, it's almost like it was pre-planned. I mean, it's crazy. They just can't do any right. But I will point this out because you just made a good point, which is auto fleets take 15 years to turn over. Now, I saw this stat and I haven't confirmed it, so I'm just going to assume it's correct, which of course everything in the internet is correct, so why not? But what the stat said was basically, as of today, 83% of the world's energy comes from fossil fuels. So 83% of the world's energy comes from fossil fuels. And the interesting part of that is that's down 3% from 20 years ago. So all of our efforts to get rid of fossil fuels and all this, 3% lower. I mean, that's insignificant. And they're talking about being carbon free in 20 years. That's never going to happen. And I think that what a lot of people realize is that is they, and this, I'm not going to get into political rant as Phil may not know, but we don't really get into politics in the show because it's kind of beneath us. But if you look at the global warming conversation or the climate change conversation, there's an intent to green the planet, which I think we can all agree nobody wants a dirty planet, right? So let's all get on the same page there. But the practicality of doing that is not easy. And if it's taken 20 years to drop 3%, maybe you drop 6% in the next 20 years, you're still looking at 77% of the world on fossil fuels. So the point is, any of these claims that, we're going to be carbon free emissions and this and that by the end of the decade, it's political talk. It's not practical. And I think if people try to do it practically, it's just going to cause more pain for people who are in the lower socioeconomic classes. So people who don't have money are going to get hurt the most. And I think that's the thing that really annoys me the most, is that people are doing this and they don't understand the consequences that they're giving to people. They just say, it's for the better of the planet. I'm like, do you just hate people? Because a lot of people are going to get harmed by this. Not saying it's not a good goal, but if you're going to kill half the planet in your goal to green it, is that the right thing? No, some people might say yes. I'm not in that. I don't think that many people should suffer, but I think that there are people who do, and I think it's important to just put things in context, right? And understanding that the implications of a path have other unintended consequences that are going to affect people in drastic ways. So, yeah. So I don't know. What are your thoughts, Phil? Is my stats right, or what do we got here?
I can't say for sure about the 83%, but the general premise, I agree with it. I know I've had these debates with my oldest son. He'll come, Dad, we got to get clean energy. We got to be carbon free, right? We got to be greener. I get it, but it can't happen that fast. You got right. I talked about the cars, but think about how many homes are heated with natural gas in the Northeast. You got homes that are heated with oil. Natural gas, it's cleaner than oil, but it's still not. It's still got hydrocarbons. And then you've got factories and you've got so many businesses. It goes into plastics and so many other things. It's not like you could just suddenly turn on a switch and say that stuff's going away. And you're right, the people at the lower end of the socioeconomic spectrum, they're the ones that are going to be hurt the most if they were put into a position where they had to suddenly replace all these things. It's just what we want as an idealist can be different from what reality is.
Yeah, and just for reference, I mean, when I had a condo, we had electric heat, and that's how we heated the home, and it was expensive. I paid the same amount for electric heat in a smaller condo as I pay now to heat my house. Actually, I pay less, a lot less. And come to think of it, I pay a lot less to heat my house now, and it's a house, not a condo. It's a house, and to heat my house now with oil, with gas, not gas, but oil heat, and and that's just a small example. That's just one person, right? And so, I think the challenge, the unintended consequences are really important. And unfortunately, people tend to vote with their emotions instead of their logic. And, a lot of these things is important to have these conversations, right? And to have both sides so that you can come to some happy medium, because I don't have all the answers. I don't know what's right. That's what we talk about in the show. Like, it's not about being right and wrong. It's about teaching you guys how to think about different topics. So you're better thinkers, which allows you to be more thoughtful and come up with better outcomes, whether it's your portfolio or your planning or retirement or whatever it is, right? Is just being is understanding the situation a little bit better, which allows you to make more informed and better decisions. So um, I do want to get into inflation. Actually, Phil, there was a topic you wanted to talk about, which we talked about in one of the other episodes, which I don't think will have come out by now. But we're talking about the agency debt. So can you talk a little bit about this? Because the point was made was that there's the agency debt is a lot higher than other debt. So maybe you can kind of get into what is agency debt and how does that maybe just talk about it a little bit.
Sure. So you mentioned this to me the other day, Kirk, and so I decided to take a look for myself and see what I could find out because I want to make sure that I understood it. So agency debt is basically things like the Federal Home Loan Bank, Ginnie Mae, Fannie Mae, Freddie Mac. They're there to support the housing system. And depending upon what type of debt it is, some of them are government-sponsored entities, some are not. But historically, like the government-sponsored entities doesn't mean the government's definitely going to pay back if something happened, but the likelihood that they are is pretty high. And when I was looking at spreads between treasuries, which we all consider to be safe, right, among the safest things you can have because they're backed by the US government, the spreads in interest rates between agency debt and treasuries are much wider now than they have been historically. And so to me, that implies that there's opportunity, right? To buy that agency debt. Like I can look at if I go out a few years, I talked about that inverted yield curve before where the higher, long-term rates are lower than short-term rates. Well, it's not as much the case with agency debt. And then as you go out longer, like you still have opportunity to buy some agency debt at attractive rates. Now there's some risk, right? You have call risk, right? They could take it away from you because if rates change, they could buy it back. That doesn't really happen with treasuries. So there's some factors like that, but I still think that there can be some opportunity if you're looking to get a little bit better interest rate on that fixed income portion of your portfolio and get a nice return. Agency debt presents an opportunity.
Yeah, and I asked it on the other show because the agency debt is certainly there were some issues in 2008 with that, and I think the stuff I've been seeing on the agency side, which have kind of come up, and just for reference, I mean you're looking out 10 years, you're getting 5.6%, which is 5.8 if you go out 10 plus years. I mean it's really significantly higher, and then is the risk is the return proportionate to the risk? I mean, 5.8 in this market is phenomenal. But then you're looking at Federal Farm Credit, you're looking at Federal Home Loan Banks. So those are the different things you're seeing. And really, the open question is like, is this? I mean, I'm seeing a 6.25% here. Like is this worth it? Like, what are the risks? Are the risks high, or is I think that's the open question, and that's why I wanted to ask Phil is just like with the risks involved, because if you're just shooting for yield, you're probably going to buy a bunch of bad garbage, right? But if you're but what are the risks? I mean, what do you see the risks are for owning agency debt, if any?
I guess the biggest risk is that we have an issue with the economy and housing where people can't pay their mortgages, and now all of a sudden there's nothing to support these bonds, and therefore you're not going to get paid. That's the risk. When we had 08 and 09, these things did take a hit, but you mentioned the other day, AIG was the one company in this sector of the market that really made a lot of dumb decisions, and you got hurt if you were invested there. But the other ones, you really didn't. So it doesn't feel like it's a high level of risk. It feels like that spread is enough to compensate, but I haven't gotten to the point where I said, yeah, I'm definitely comfortable with doing this. I'm still looking into it to make sure that I have the right level of comfort.
Yeah, I mean, I think there's a lot of areas, and I bring it up because there's occasionally when you're looking at a market, there's things that are a little bit anomalous. And right now, agency debt is one of those areas. As I look at this, it's just not lining up. Even U.S. Treasuries actually are higher than I would have expected in comparison to other things, right? If you look at, for instance, a 0 to 1 year U.S. Treasury is approximately 5.3% today. But if I look at a AAA corporate, which AAA corporate's like 5 companies, so a AAA corporate is 4.8. So what that's saying is a AAA corporate has lower risk than the U.S. government, which may actually be true. It's quite possible that's true. But the point is as you're looking at these, you're basically looking at trade-offs and what are you willing to give up in exchange for something else? So 5.3%, good rate. Is that the best rate? I don't know, right? And is it, is it worth it? If you look at you have to go to like a single A corporate or triple B to actually get a better rate than that. So, but the real reason I bring it up is it should cause you to pause and say, why is this the case? Right? What am I missing? Is always the question we ask on the show. So what am I missing? Right? So agencies, they're much higher. What am I missing? Right? As Phil says, well, it could have some problem in the housing markets and in the farm markets, which I think we can all agree if there's a recession, there's a lot of let's say bodies that could float to the surface during a recession. We don't know where they all are at this point, but I know they're there.
Yes.
I think we can all guess where they are. I don't know. The triple B corporate market is probably where they're all hiding, but sorry, private joke, listeners. You just happen to be in on that. But I think it's just something to think about, right? So when you're looking at fixed income, I think it was a year ago we started telling people, hey, start looking at fixed income. Didn't say buy it then. I said start looking at it and understanding it because it's been 40 years since people looked at fixed income as an asset class. So you're probably a little rusty. So, bone up on it. I'm actually going to start, and just for reference, I'm going to start putting out a handful of separate either episodes or videos on YouTube, and I may put it up in the podcast link. But it's basically questions that I get asked all the time. And I don't want to disrupt the show or the momentum of the show, but there's these special episodes. So maybe what I'm going to do is I'm going to put this out to our loyal listeners that have signed up to get on our email list and our free money. These are things that I can tell you, in my opinion, are things that are going to blow your mind that you're thinking about. And one of them has to do with fixed income. And they're in this question I get over and over and over, which is, I don't understand. My treasury, you told me, is 5.3%, and I'm only getting 75 basis points from it. Right. And I'll tip my hat a little bit. Well, I want to let Phil answer it, and the listeners can listen to the special episode after. So why would that be the case, Phil? Why would somebody get 75 bips or basis points on the yield, but the real yield is really 5.3?
Because if you look at new issues, when I've looked at those, the government might be paying no interest. So, but the rate we just said is 5.2, 5.3% on a 1-year treasury. So if it's issued paying no coupon, no interest, no basis points, I got to get that someplace. So how do I get that? I pay less than, if you think the base value is 100, I pay something between $94 and $95. And that way I get my return through growth in the value. So then I paid 90, let's say I paid 95 for it today. A year from today, I get $100 for it. So that's what's happening, so that they're not paying out current interest. And so the same thing can happen too. Sometimes you buy a 1-year treasury and it might have been a 5-year treasury at one point. It's just back in the market because they can be bought and sold. And so 5 years ago, rates were really low. So you might have that 75 bips that Kirk talked about. That might be all it paid, but the current market says that you should be getting 5%. So you're going to pay less for it, and you're going to get the rest of that through. It's like appreciation, but it's from a tax perspective, it might be classified as something different, but you're just going to pay less than the face value. So you're going to get part of your return by that asset going up to face value over time.
Yeah, no, that's a great explanation, Phil. Thank you. So so I mean, if you look at all the treasuries out there, I mean, I'm just looking at the screen right now, the ones that are for sale in the short term, they range from 0% up to 2%. But yet the the rate of return is 5.25, 5.35, right? And that's the range. But the coupons are all low, and they're low, as Phil said, because people are selling them, and they owned them low, and now they're selling them at a discount. And you can buy them at a discount, and you get the difference between the discount and the par value, which is what they pay you back at the end. So I think it's just important to understand. I get the question all the time, and so I imagine the listeners are having this too. If you're buying individual bonds, if you're buying funds, I would just be mindful of that. Funds can be dangerous if interest rates are rising, because you're going to lose money, and you can't. There's not much you can do about it because you're not managing it actively. But if you own your own funds, then if you do it right, if you buy it and hold it to maturity, you're not really going to lose money. Well, not in this market, you're not going to lose money. But it might look down on your statement. So it's possible it could drop if the interest rates rise. It could drop in value in your statement. But it doesn't matter, because at the end, you know what you're getting for interest, you know what you're getting back at the end, and that's all that matters. A point-to-point kind of conversation. So what else, Phil? We got a few more minutes here before we wrap it up. But what other areas do you think we should talk about this week that are kind of interesting to you?
Another one that I know it comes up all the time, but there's still some anomalies, and I like to talk about anomalies. Let's look at inflation, right? We know that inflation was really high. We know that it's come down some. We know that that's one of the things that's made interest rates going up. But one of the things that I think sometimes gets lost in the shuffle is if you go back to our discussion about housing prices, those people that have mortgages that are in that 3% or lower rate, or even 3.5%, right? Their payment's fixed. So their housing costs aren't changing. So to me, that's something that's helping to support what's happening with pricing, right? Because that number staying the same, hopefully over time your earnings go up, but your housing costs stay fixed if you don't move. And so therefore that gives people more disposable income. And then the other thing that you have is, remember, we had COVID and everybody was stuck at home. And so now there's a lot of demand for a lot of services and things like that we couldn't take. And so that's also driven up prices. So we have some factors, I think, that are affecting inflation that are, to me, out of the ordinary. That's part of it.
Okay. So one of the other things we talked about before the show is the discrepancy in the markets. In that we've talked about this in prior episodes, and how the market is kind of well, let's just say hard to follow, right? You've got the market price for the index, and then you've got all the different stocks in that, and there seems to be a big discrepancy in terms of uniformity of performance on the index. So can you talk about that a little bit, Phil? I'm gonna share a screen here for a minute, but maybe you can kind of talk about your thoughts there.
Sure. So one of the things that I think you hear a lot is the idea that we have these 8 stocks and they're driving the market. And it's Nvidia, it's Apple, it's Amazon, it's Facebook or Meta, whatever you want to call it. Like, these stocks are just driving the market. But that's how it often happens, that you have a few big stocks, and the composition of what those big stocks are constantly changes. And if you look at the top 10, the biggest 10 stocks today, and you look at them 5 years ago, they're not going to be the same. But if you look down below, and we associate a lot of those with technology, but I'm looking at a list that I shared with Kirk that has what industries are doing well if we go back to that October low. And I know it's just a point in time, but we have home building is doing really well. Casinos and gaming are doing really well. Healthcare supplies, those are all industries that have gone up a lot, and they're not technology, but we only hear about technology. And if you drill down and looked at the S&P and the 500 companies in it, you would see that there are plenty of companies that are up. We just hear about those others. It's not like we look at the 8 and that's all it is. There are things in the index that are moving prices lower and things moving prices higher. You have to parse. That's why you pick it. You don't buy. I mean, you look at it, investments, you pick the ones that you think are going to do well. Not everything does well in every market. I mean, you get back to what Kirk said earlier, right? Different investing in a bear market and a bull market too. So there's different investments for different environments, but it's not like one thing is always it. That might be what we hear, but that's not always what it is.
Yeah, I think it's an important takeaway. What Phil was saying is I mean, if you look at right now, growth stocks are in favor. Last year, value stocks actually held up pretty well, considering. But value stocks have been out of favor for basically 23 years. So you get a little bump here and there. You're like, oh, great, value is going to take off again last year, and then nope, sorry, we're back to growth again. and and we have a whole generation of people who don't even know what value stocks are, just like we have a whole generation doesn't know what bonds are. And I think it's really disruptive to the I guess the diversity of the industry, because people only just, you don't have to be an expert anymore. Just put all your money in Nvidia. You don't have to, it doesn't make any sense, but that's all people do. Pick 5 tech stocks, put all your money there, and you're going to be fine. That is such a poor investing strategy, but it's what so many people do because it's worked for so long. And are they great companies? Yeah, I don't want to take anything away from them, but are there other companies that are also great? Absolutely. But as Phil said, you're not going to necessarily hear about them because they're not sexy. They're not making front page news like AI is. Home builders, yawn, right? I mean, it's not interesting. But at the same time, the economy is very diverse. If you're going to have a recession, it's going to hit everybody. And I think, as we saw last year, when you have higher interest rates, it affects tech quite a bit. For whatever reason, apparently we have high interest rates still, and it's still not affecting tech. So I don't know. The market needs to make up its mind, but I think it's important to kind of understand the how widely diverse this is. But I think if you look at the markets, if you look at the different markets this year, there's a big difference between tech and everything else, right? The Nasdaq's up a lot. Small caps are up a little. They weren't up at all until like this week, and then everyone's like, "Oh, small caps are taking off," and they took off, and now they're coming back down. So they're not really going anywhere, but people got excited for a whole 5 days, and so that's really gone nowhere. The mid caps have basically gone nowhere except for this week's bump. You've got the Dow. I don't even look at the Dow. I mean, who looks at the Dow these days? But the Dow's up like 1 or 2%. Earlier this week, it was down for the year. But the Nasdaq's doing great, and it's. But I will point back to the point we make earlier in the show. The Nasdaq's up a lot. However, you know what the low point was? December 31st. That was the Nasdaq low point for last year, December 31st. So it looks awesome this year, right? Because it's like, wow, it came off the low. So Phil's point of, well, off the low, it did this. Actually, it does matter for the Nasdaq because January 1st was like the first day and it went up a lot. So you can have fun with numbers. I don't hold a lot of credibility with this sort of thinking other than everybody looks to it. So you kind of have to. But I think it actually can be pretty disruptive to solid investment philosophy, because people just get so stuck on these one point in time and say, well, it's this, so you have to do this. It's obviously you have to pick it somewhere. So you have to pick a point, but that point's just as good as any other. But if you're looking at it, if you take a step back and look at the broader picture, you can see what's going on. You realize that things are actually not as rosy across the board. There are just certain areas that are taking a lot of the heavy lifting, and then everything else is pretty much lagging. And I'll leave this off and I'll let you wrap it up, Phil. Is if you look at like an index like the S&P and then you compare it to an equal weighted S&P, right? And the difference being the S&P 500 is market cap weighted, which means the largest companies have the biggest weighting. So I think Apple has like 7 or 8% of the whole index. So out of 500 companies, like 7 or 8% of the index performance is due to one stock. 25% of the index has to do with 5 stocks. So 5 stocks compared to 495 stocks, those 495 are 75% of the index. These 5 are 25%. That's a problem in itself. So if you look at the performance, and you might see, oh, it looks great, it's due to those 5 stocks. If you look at the equal weight, which means every stock in the index has 1/500th% of the performance, so it's equally weighted across all the stocks that are in that index, then the performance for the year is actually a lot less. And so you can pull some of these statistics up. There are some ETFs out there that do this, and they will compare the equal weight versus the index, and you'll see there's a big difference. And I'm not saying you should invest in one versus the other. That's not my point. My point is you should understand the relationship. So if you see things that look a little interesting, like I said, that's interesting, it should cause you to pause and say, what am I missing? Now, it may be nothing, right? It may be that you got you're on the right track, but it should cause you to at least take a look and say, am I missing something here? If 5 stocks are driving performance and everything else is lagging, maybe I should be cautious, right? Or maybe at some point the rest of the market will pick up and catch up, right? Which is another point I want to consider. But just understand the dynamics of your investing. So, Phil, maybe you can kind of give us your final thoughts, and we can wrap it up here for the week.
Sure. And so one thing as you were talking, Kirk, and I go back to what you said too earlier about mental models, right? You said, what am I missing? That's something that we always have to think about. And I think confirmation bias, like that's a big thing that we have, right? We want to be right. So when you're looking at something, you only look for people or whoever is out there that you're looking at that agrees with you. Don't just look for who agrees with you. Find somebody that has the other point of view. Understand what that is. Maybe you are missing something. And if you just read the people that have the same opinion, you're never going to find out and you're not going to know about it. So it's always important to understand both sides, because forecasting is not easy to do. Predicting is not easy to do. Valuing a company or the stock market is not easy to do. Understand both sides so you can make an educated decision and have a process too. Like, I can decide to buy something. It can be a good decision because I did the right research and everything else, or I could just get lucky, right? And the only way I'm going to start to know the difference between the two is if I follow the same process over and over again, so that I know that it's much easier to identify errors than if I'm just letting luck be the driver of everything.
Great. Well, Phil, appreciate your insight this week. Thank you for joining us. I always love having you on the show. Where can people find more about you?
So thanks for having me, Kirk. I enjoyed it, as always. My firm is Apprise Wealth Management. You can go to apprisewealth.com. If you go to apprisewealth.com/ebook, you can download a free ebook that I have. You can also subscribe to my blog. I blog every week.
Awesome. Well, Phil, thanks again for joining us.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.